Good afternoon. In today's video, we will be reviewing the market structure framework. This is a beginner's guide that is designed to help you understand how to correctly trade the ES S&P 500 futures chart that we stream daily. We use a systematic, levels-based approach to keep you on the right track throughout your trading day. Members in our room also use our ES chart to trade SPX and SPY options. The market has structure. Through rigorous backtesting over hundreds of trading sessions, we've come to find three key truths about the market. Number one is the market is not random. Price moves with predictable patterns. Number two is structure leaves clear clues about future movement. And three, success comes from reading the current environment, not simply guessing what is going to happen. At Active Range, we use a framework built around specific levels and different spreads to understand what the market's actually doing, and more importantly, what it's likely to do next. What are levels? An overall description is to think of them like zones. Our algorithm generates distinct objective levels, just like zones on a map, that show where price is likely to slow down, reverse, break out, or accelerate. These are not random lines. They've been calculated using market structure, cycle behavior, price geometry, options positioning, and institutional flow, which, as we know, tends to drive the market in certain directions. Levels help us be aware of where big money is focusing its attention. We can expect significant trading activities in these marked zones. Setup levels and directional bias. Our algorithms generate distinct objective levels for trade entries. You will see objective levels on the chart with entry zones that provide clear, unbiased trade signals. There'll be no confusion on which way you should be leaning. The levels separate long, bullish, and short, bearish entries that are derived from advanced order flow signals. The zones are in alignment, and what I mean by that is longs will appear in our buy zones during bullish bias, and shorts will appear in short zones during bearish bias conditions. These levels can be used for cross-market correlation with other instruments, with ES leading the way for cash market confirmation. The power of the spread. The difference between levels, we call it the spread. It's really one of the most important pieces of information on the chart. The spread acts as a pressure gauge, revealing market pressures and conditions. It also tells us how much institutional interest, liquidity, and momentum that exist in the current environment. The spread provides signal strength, letting us know if market conditions are clean or chaotic. The different spreads provide a trading edge and helps you decide when to take a trade or wait for a better opportunity. Here's a complete picture of the spread analysis. There are four types of spreads. The first one is it's a tight spread with only 2 to 3 points between levels. This spread delivers a choppy, messy environment with low participation and lots of whipsaw price action. The second one is the 5-point spread. We find this spread ideal. It provides balance with cleaner moves and a more predictable reaction. The third one is the 10-point spread. These are the wider spreads, and the zones, they signal major decision areas because institutions will likely defend their positions in those zones. And the last one is the 20-plus point spread. These are very wide spreads that occur when there is strong momentum in the market. You will often see a efficient price movement as well with a spread of 20. Let's look at each one of these individually. Here's a low interest environment. This is the spread of 2 to 3 between levels. It's usually the hardest to trade for beginners. Here you'll have low institutional participation. There really is no clear market direction. You'll often see quick and erratic moves both ways. And there's also a higher probability of whipsaws and fake breakouts. They're very, very common. Our approach is we generally avoid trading in this environment. And if we do, we go lightly because the probabilities are low. Your goal here isn't to trade more, it's to trade better conditions. Our bread and butter zone spread. This is the spread of 5. We find this ideal for building skills using our algo levels. The spread offers balanced market participation with healthy liquidity of both buyers and sellers engaging. Levels tend to hold and react cleanly on a consistent basis and become more predictable at key levels. The spread offers cleaner moves with clear patterns. A price hits a level, it reacts. A price breaks a level, and it continues. We find this spread to be the most ideal and consistent environment for beginners, allowing them to build confidence through structured-based trading. The spread of 10, major decision zones. These zones, they become high impact areas. We call this one the move stopper. A spread of 10, it occurs when the market has already moved significantly. You'll find momentum slowing near zones with a strong reaction. The big institutions are deciding what to do next, such as will they continue the trend or defend in reverse direction. Patience here, it plays a big part when we have a spread of 10. There will be times where price will churn in this zone for a while before a clear direction is made. Keep in mind that not every level is for trading. Some are for watching and learning. The fourth one is the 20 plus point spread known as expansion environment. Now, these are very wide spreads that occur during really fast market movement with strong momentum and price running efficiently from level to level. A spread this size indicates high institutional participation from larger players who are driving the direction of the market. This spread also offers some of the cleanest directional environments with smaller pullbacks. This is where things finally click for beginners. The noise is reduced, direction is clearer, and momentum supports your trades. Putting it all together. Over time, you will learn how the spread connects to three market phases. With the reset phase, you will usually see tighter spreads, choppier movements, no clear direction while the market prepares. With the expansion phase, you will commonly see wider spreads, stronger market movements, clearer direction, and watch the market deliver price action. During the exhaustion phase, you usually see irregular spreads, slowing momentum, and increased reversals while the market's finishing its prior day move. Be sure to understand the spreads and what day you're in so you can trade the specific conditions and apply a good strategy for each environment, and by doing this, you'll actually learn to build consistency. And with consistency comes success as you understand where to trade and when to wait. Just a quick recap again on the spreads. Tight spreads equals uncertainty, medium spreads equal structure, and wider spreads equal momentum. Sometimes the best trade is no trade at all. Learn to remain patient, learn our levels within the system along with the spreads, and you will be amazed how well they work together. In the next video, I will discuss understanding the zone model.